Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you on Tuesday, October the 11th. The year's 2022. Let's talk trading. Learning to lose with Walmal. As always, these videos are for educational purposes only. Your results may differ from mine and different from Walmal's. Walmal. Learning to lose. It's something that traders should probably learn before they learn how to win. What do you think?
Well, the thing is, we all take losses, but the thing is, I would agree with you. We need to go and learn to lose. There's a difference between taking losses and learning to lose. And the difference is just simply this. When you're trading, you're going to lose. There's no question about it. What do you do with that loss? And how do you lose? Those factors really build into your trading plan. Because here's the reality. If the trade goes against you and it doesn't come back, you're going to lose. Okay, well, where are you going to lose on that spectrum? Are you going to lose where you should have gotten out because that's where your trading plan says to get out? Or are you going to sit there and lose and then continue to lose more and more and more and more until you've lost, as opposed to losing? And what I mean by that is let's go and create some hypotheticals. Let's go and say that you're willing to go and lose $100 on a particular trade. Okay? And you hit that $100 and you go and say to yourself, I can't lose $100. Now you got that's a pretty bold thing to go and say, because if the market's going against you, everything on the chart tells you that, hey, this is not coming back, and you say, I can't lose $100, you're right. You can lose $200 or $300 or your entire account, and that's the danger if you don't learn to lose, because sometimes you just got to go and say, I'm cutting my losses. It's sort of like you got to go and do what you got to do, and just say, hey, it didn't work out. That's okay. I say it all the time. It's the type of thing when you go and take a trade. What you should be risking is the amount of money that you're willing to go and take out into the middle of the street, pour some gasoline on it, and light it on fire. Okay, that's what you should be. That's what you should be risking. And if you have that attitude, then you're okay. Because if you're willing to lose that $100, or let's say you're willing to lose $500, or whatever that number may be, if you're willing to go and light that up in the middle of the street, okay, and that doesn't affect you, that's where you should be. That's how much you should be risking on a particular trade. And you need to go and do that. And you can't go to the next step of, and I'm going to be perfectly transparent here. I used to do it all the time and sit there and I'm down, I'm at my limit. Again, let's say my limit's $100. I'm at my limit. And it's like, I can't lose $100, and I know this thing's going to come back. It's got to come back. The market always comes back to the top side. Yeah, it usually does. But the problem is I'm already down 100, and I'm risking my account. And I'd sit there and say, oh, I'm only down, 5 pips. It's okay. I'm only down 10 pips. Oh, that's okay. And I keep on, and I would drag my stop loss. I drag it further and further away from my entry, and just keep on increasing my loss and increasing my loss and increasing my loss. And the next thing you know, now I'm at a point of like no return. And I'm going to be honest with y'all, I went and blew an account doing that, and I'll guarantee anybody that's traded at some point in time, especially in the beginning, has done that. And you just have to go and say, this is the line in the sand. I am not moving my stop loss. This is the line in the sand. And be willing to accept that that's just what happened. And wait for the next opportunity and where you can make it up.
Right. One of the things I think is sometimes the language that we use, it gets to us, because instead of looking at it as a loss, and let's say a permanent loss, because that's usually what loss means, is it's permanent. Look at it as a like a temporary pause of your position. So in other words, let's just say if looking at the 1 hour pound dollar right now, it's oscillated between the daily open at 1076 and it's up to 1090. So if you're taking a Walmal trade at 80, and let's just to the south, and let's just say you didn't take your 3 pips that you could have had. And so now you're down 9 pips, 10
Right.
pips. So if you say, well, if I exit here, and it keeps going up, when it comes back down, if I pause the trade here, I can get back in that trade right here, and then maybe it'll go back to where you actually entered. So I used to think of it, or used to explain it like if you get in an elevator and for whatever reason you want it to go up and you get in the elevator and it's going down, and let's say you're in a skyscraper and you're on the 50th floor and you don't want to go down 50 floors, you wanted to go up 3, you would probably get off the elevator at floor 49. It's like, oh, got on the wrong elevator. You wouldn't ride it all the way down to the lobby and then get back on, would you?
Especially if you were late for a meeting or something. If you're on vacation, you may do it for the amusement of it. But, you're late for a meeting, and that's probably more applicable to trading. You don't go and take you don't take the round trip on the elevator. You get off, At one point in time, I worked at BlackRock, the BlackRock building in New York City, which is the CBS headquarters. And in that building is like 62 stories. And, it could take you, if you were to ride if you weren't on an express elevator, it could take you, 10 minutes to get from the bottom to the top. Why in the world would you go and be sitting there for 10 minutes, going in the wrong direction? You just don't do it. You get off and you just wait for the next elevator to go in the other direction. And that's what you got to do. That's trading. Get off the elevator. I like that analogy, Kiro. Is get off the elevator, take your small little nick. You lost a minute or two in the elevator. Okay, that's no big deal. I can go and take the next elevator, and I can make up. I can make that up, and it may even take 2 trades to make it up. So what? That's just life, and you just move on from there.
So it's just one of those things because, like you said, you don't want to lose that $100. It's like, oh, just temporary pause.
Yeah, it's just I wouldn't even call it a setback, and it's just part of trading. And again, in terms of transparency, today my efficiency using the trade report says that my efficiency today is 73%. That means if I took 10 trades, that I went and lost what?
3.
Like 2.5, 3 of them. So that I lost 3 trades somehow. Okay. Yeah, that's life. It's not the end of the world, but it also means I won 7 trades, and that's the thing. The 7 trades more than made up for the 3 losses, and that's just how you have to go and look at it.
Yeah, and the other thing I was going to say about that is sometimes people like to average in. You do it, I do it, and I'm sure a few of the viewers out there, fellow traders, do it too. And then when you get out, sometimes maybe your original position, you actually get out underwater. So the question is, what would have happened? Let's just say you get out, and on that trade, one of the trades, maybe you took a 3-pip loss. What if you had taken that 3-pip loss or got out of the trade? How many trades could you have possibly gotten in that you passed up because you were waiting for a signal to go in your original direction as opposed to the current direction?
Exactly, especially if you're a U.S. trader and you're trading on a U.S. broker where you're not allowed to hedge.
Right.
Luckily, the broker that I use, it's not a U.S. broker, but unfortunately, they don't accept U.S. clients anymore. But the thing is, I can go and let's say I took a long and it went against me, and I said, you know what, I want to stay in that trade because I want to, and I think it's going to come back. You know what, I'm going to go and not just hedge it, but I'm also going to go and do what I call a hedge plus one. In other words, I'm hedging the original trade, and in addition to that, I'm taking another trade. So let's say the original trade was a long. Now I'm going to go and take 2 trades, to the south. and and then that way, once I make the money on the short trade, and I see a clear signal to go north again, I'll go and exit both my shorts and then go long, and hope that I can go and get that first original trade, make up some of that, that's not a loss anymore because I hedged it. At least make up the amount that the difference of the hedge, and then you're good to go. But the thing is, if you're a U.S. trader, you can't do that. The rules don't allow you to do that unless you happen to be lucky enough where you got grandfathered in on some broker that allowed a U.S. trader to trade on their platform.
I know to think that in the land of the free, but that's a political discussion.
Yeah.
So I guess the thing is, there's not too many games that you don't quote unquote have a loss. In baseball you give up runs, in basketball you give up baskets. I mean, in hockey you give up goals sometimes because the other team is gonna score. So if you think about trading, you get out there, there's other traders, they're gonna score against you.
Oh yeah. I mean, and it's like, using the analogy of baseball, there are times when you give up a run. You specifically give up a run because, it's the type of thing that if I go and give up the run, then the reality is that I'm now in a better position to get out of the inning or get out of the game with a win because I know that this particular player coming up could clear the bases, and then I'm going to permanently lose as opposed to just not being able to get out of the mess. Sometimes you just got to go and take the small loss, and that's the thing. That's the key. Take the small loss. However you want to do it. You want to take your small loss by going and figuring out a scheme to go to average in. You want to take the small loss by going and hedging. You want to take the small loss by just going and getting out. Once you see the trade's not developing the way that you thought it was going to develop, then that's what you do. And I would go and say that, your best opportunity as a new trader, just take in the beginning, just go and take the small loss in the beginning as you see the trade not developing the way that you should. And sure, you're going to get cut up a little bit, but it's going to teach you some discipline. And, I think you'll be better off. But that's just my opinion. That every trader's got to figure that out for themselves.
Yeah, because like right now, I mean, I'm kind of glad we're doing the video because this is just some crazy price action in the sense that the pound is range bound between the 80 and the 90. It just doesn't seem to want to go one way or the other.
Eventually it's going to bust out of there.
Yeah.
But I don't know when it's going to do it. It's just eventually going to do it. And when it does it, it's probably going back up to the 00 if it goes to the long side. And if it doesn't go that way, then if it busts the 80, it's going down at least to the 75. So,
Well, I'm looking for it to bust the 76 south because that's the daily open. That's yesterday's open. That's coming out of the wick zone.
Right. Yeah. But that's part of what trading is. And, people say, well, in fact, I was talking to someone the other day who used to do FOREX trading but doesn't do it anymore. And I asked him why. He said, it's nothing but a scam. All they do is take your money away. Well, the problem is, I didn't spend enough time with this fellow to figure out what he was actually doing. But more times than not, when I speak to people who say that, it's because the reality is that what they've done is they're constantly not knowing how to take a loss. In other words, they're not willing to cut their losses short and then go and actually take the trades, take all of the trades. That's what you got to do. Just, sit there, take your loss, and move on from there.
Yeah, and the fastest 15 minutes of trading is up once again. So, fellow traders, we talked about making a pip. So we're talking about, some of the fundamentals here. And the other one is taking a loss, whether it's 1 pip or 10 or $100, however you set your risk. Because remember, you don't want to risk or lose any more on any one particular trade than you're willing to lose, because it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.